Anthropos, and very quick update. I'm following from the work that I showed you in the live, etc. Very simple thing. So I managed to put together the ECB data of domestic demand and gross domestic product at market prices. So it's the without discounting for inflation. So the interesting thing that we can appreciate here is that domestic demand, whether it's quarter on quarter or year on year, measured on a quarter basis, it's very it's really linked to gross domestic product. Okay, now I'm stumbling, but it's evident in the chart. The blue and the green lines, they are domestic demand and gross domestic product market prices quarter on quarter. You can see how they are very correlated. They move, they are synchronized. So domestic demand, it's a quasi proxy indicator of how economic growth is going to develop in Italy. And with this, only looking at the chart, we can put together two things. One, that the idea of using a large fiscal stimulus, you can see that the pass-through effect in the economy is very short-lived. And what it's really necessary, it's providing a stimulus to the private sector for improving domestic demand, internal consumption, internal demand for consumption or investment. And that means that wages have to be improved drastically. So that's the basic thing that we can understand. So that the largest problem for the economy in Italy, for the average working person or the average household, the average family, is that wages are too low. And that comes up in gross domestic product, in GDP. You can see these lines are gross domestic product at market prices. At the third quarter of 2025, it's zero, almost zero. It's very flat. You can see here 0, 0, 0.3, 0 point something. So if we go down to the latest data, so okay. So here it's demand, internal demand, it's negative, it's flat in the first quarter, which is normal, and 0.7%. Those are the GDP numbers, the economic growth numbers. So they are very linked. They are mostly, that's demand compared to the previous year. So the quarter-on-quarter demand, which is minus 0.09 and 0.69, these are the quarter-on-quarter figures, which are very much correlated to the gross domestic product quarter-on-quarter. So it's a matter, it's the bulk of the question is that consumer demand, it needs to be improved, and you don't need to do fiscal spending. What it's necessary is that wages have to rise, have to be improved, have to be updated to what is the cost of living. And for that probably you need legislation and so forth and so on. But I don't want to go into legislation. But the main concept is that the evidence that is in the statistical data is that consumer demand is strictly linked to GDP, or GDP it's a mirror effect of consumer demand. And the red line here, it's domestic demand, but this GOY, it's the quarter on quarter, it's the quarter of this year or the current year compared to the past year. Okay, while the GO1 is the quarter on quarter on the same year. So demand this year, it's keeping up compared to the past year. But GDP, it's sluggish. It's not enough for doing fiscal spending and then improving the debt to GDP ratio and not having all sorts of problems in terms of fiscal sustainability. And it's not a question of paying more taxes. It's a question of having high wages which then allow the economy to improve, because higher wages is higher consumption, higher savings, so forth and so on. That's the thing. But last but not least, finally, I could uh, put together more columns, more data columns here on the thing. So Excel, it's doing its thing. So see you to the next time.